In February 2021, Cathie Wood's ARK Innovation ETF managed over $60 billion. By December 2022, it had lost more than 75% of its value. This wasn't a story of bad luck or a market crash that hit everyone equally. The S&P 500 was down 18%. ARK was down 75%. This was something else entirely. Dealt of my Haggett. This was what happens when one of the most powerful psychological forces in human cognition gets weaponized by conviction, amplified by media attention, and turbocharged by retail investor capital. Confirmation bias is deceptively simple. It's our brain's tendency to search for, interpret, and remember information that confirms what we already believe, while ignoring or dismissing evidence that contradicts it. We don't do this consciously. We're not deliberately lying to ourselves. Our brains are just really good at pattern matching and really bad at questioning patterns once they're established. Picture this scenario. You're convinced that electric vehicles are the future. Perfectly reasonable belief. Now, every time you see a Tesla on the road, you notice it. You read articles about EV adoption rates. You bookmark studies about battery technology improvements. When someone mentions concerns about charging infrastructure or lithium supply chains, you mentally file it under temporary problems, or they just don't get it. This isn't stupidity. It's how human cognition works. Psychologists Peter Wasson first documented this systematically in the 1960s with his famous 2-4-6 task experiment. Participants were told that the sequence 2-4-6 follows a rule, and they had to figure out what it was. Most people assumed the rule was even numbers increasing by 2, and then only tested sequences that confirmed that hypothesis. 8, 10, 12, yep, fits. 14, 16, 18. Still fits. The actual rule was simply any ascending numbers, but participants rarely tested sequences that might disprove their theory, like 3, 5, 7, or 1, 2, 3. They kept confirming what they already believed until they were absolutely certain they were right. Then they announced their answer. And they were wrong. In Wasson's experiments, less than 20% of participants discovered the correct rule on their first attempt. The rest had convinced themselves of the wrong answer by gathering only confirming evidence. Now imagine this same psychological mechanism. But instead of a harmless number game, you're making decisions about where to invest your life savings. And instead of a quiet laboratory, you're doing it in front of millions of people on Twitter, CNBC, and Bloomberg, with your professional reputation on the line. In early 2021, Cathie Wood was the hottest name in investing. Her ARK Innovation ETF had returned 153% in 2020. ARK's flagship fund was up another 35% in January 2021 alone. Assets under management exploded from $17 billion in early 2020 to over $60 billion by February 2021. She wasn't just running a fund, she was building a movement. Wood's thesis was bold and clear. Disruptive innovation was creating a new world. Tesla wasn't a car company. It was an AI company, a robotics company, an energy company. In her base case scenario, published in March 2021, ARK predicted Tesla stock would reach $3,000 per share by 2025. In the bull case, $4,000. At the time, Tesla was trading around $700. This wasn't just optimism. This was a 5x return conviction. And here's where confirmation bias doesn't just whisper in your ear. It shouts through a megaphone. Every quarter, ARK published detailed research reports. These weren't short opinion pieces. These were 60, 70, 80-page documents filled with data, charts, projections, and analysis. They highlighted Tesla's growing production capacity. They modeled robotaxi revenue that didn't yet exist. They calculated the value of full self-driving software that wasn't yet autonomous. They projected energy storage growth rates. They emphasized gross margin expansion. Every single data point supported the thesis. Meanwhile, critical information got less attention. Tesla's valuation was already pricing in perfection. Traditional automakers were investing hundreds of billions in electrification. Competition was coming from every direction. The Federal Reserve was signaling interest rate hikes, which historically crush growth stock valuations. Regulatory credits were becoming a smaller percentage of profit. None of this made it into the bull case with equal weight. In April 2021, Wood appeared on CNBC and doubled down. Tesla to $3,000. When the stock dropped from $900 to $600 by May, she bought more. When it rallied back to $1,200 in November, it confirmed everything. See? The thesis was right. Then the real collapse began. By December 2022, Tesla had fallen to $120. ARK's flagship fund lost 77% from its peak. 77%. That's not a correction. That's a psychological case study. What happened to ARK wasn't unique to Cathie Wood. It's a pattern that psychologists have documented for decades, and it gets dramatically worse when you add three ingredients: public commitment, financial incentives, and social reinforcement. Daniel Kahneman, who won the Nobel Prize for his work on behavioral economics, spent years studying how smart people make systematically bad decisions. In his book Thinking, Fast and Slow, he describes confirmation bias as part of our fast thinking system. Our brains are designed to make quick judgments based on limited information, because for most of human history, hesitation got you eaten by a predator. The problem is that investing doesn't reward fast thinking. It rewards accurate thinking, and accuracy requires actively seeking information that proves you wrong, not just information that proves you right. In one famous study, researchers asked participants to assess whether a particular defendant was guilty or innocent. They gave half the group evidence suggesting guilt and half the group evidence suggesting innocence. Then they gave everyone the full set of evidence. What happened? People who formed an initial opinion barely changed their minds. They paid more attention to evidence that matched their first impression and discounted contradicting information. Their final verdict was almost entirely determined by which evidence they saw first. Now add money to this equation. In 2006, researchers at Stanford scanned the brains of people evaluating political information. When participants encountered information that contradicted their political beliefs, the parts of the brain associated with reasoning became less active. Instead, the emotional regulation centers lit up. The brain was literally working to protect the existing belief rather than evaluate new information objectively. And here's the kicker. When participants successfully defended their existing belief against contradicting evidence, they got a hit of dopamine, the same reward chemical associated with eating, sex, and cocaine. Being right doesn't just feel good, it's neurologically addictive. For someone like Cathie Wood, who had built an entire public identity around disruptive innovation, who appeared on television defending these positions, who managed billions based on these convictions, the psychological pressure to find confirming evidence wasn't just strong. It was overwhelming. Every Tesla delivery number that beat expectations was proof. Every Elon Musk tweet about full self-driving progress was validation. Every competitor stumble was confirmation. The addiction to being right became self-reinforcing, even as the market was screaming that something was wrong. Here's where the story gets darker. Confirmation bias doesn't just hurt the person experiencing it. It creates an ecosystem that can be exploited. And in ARK's case, millions of retail investors became the collateral damage. Between 2020 and early 2021, over $30 billion flowed into ARK ETFs. The majority came from individual investors, not institutions. These weren't Wall Street hedge funds. These were people investing their retirement savings, their house down payments, their kids' college funds. And they weren't just buying a fund. They were buying a belief system. Social media amplified everything. Reddit communities formed around ARK's holdings. Twitter accounts tracked every trade Wood made. YouTube channels explained her thesis to hundreds of thousands of followers. People called themselves Cathie's disciples. And here's the critical thing. They experienced the exact same confirmation bias, but with even less information. They saw ARK buying Tesla. That confirmed it was a good investment. They saw the stock go up. That confirmed the thesis was right. They saw Wood on CNBC predicting higher prices. That confirmed they should hold through volatility. Every piece of positive news was shared, celebrated, and amplified. Now, negative news was dismissed as short seller manipulation or mainstream media misunderstanding disruption. This created what psychologists call a belief echo chamber. Morgan Housel describes this perfectly in The Psychology of Money, when he writes about how we don't just want good investments. We want investments that confirm our worldview. Meanwhile, Wall Street noticed. Short sellers began targeting ARK's holdings, knowing that confirmation bias had pushed valuations to unsustainable levels. Every time Wood doubled down and bought more of a falling stock, it provided short-term support that shorts could trade against. Some critics accused her of creating a feedback loop. ARK buys stock, price rises, retail investors buy ARK buys more stock, price rises further. All while fundamental valuation metrics screamed danger. When the cycle reversed, it was brutal. As prices fell, redemptions hit the fund. To meet redemptions, Wood had to sell holdings. Selling pushed prices lower. Lower prices triggered more redemptions. The same feedback loop that built the $60 billion fund destroyed it in 18 months. But here's the twist. Even through the collapse, confirmation bias persisted. In December 2022, with the fund down 77%, Wood maintained her Tesla price target. She appeared on podcasts explaining that the market simply didn't understand the innovation. The thesis hadn't changed, only the time frame had extended. To believers, this was conviction. To observers, it was a textbook case of a psychological bias that can't self-correct, because admitting error would mean admitting the entire framework was flawed. So how do you fight a bias that's hardwired into your brain and reinforced by success, social validation, and neurological reward systems? The answer isn't to avoid convictions. Conviction is necessary for bold decisions. The answer is to build systems that force you to confront contradicting evidence before it's too late. Charlie Munger, Warren Buffett's longtime partner, had a famous rule. He wouldn't allow himself to hold an opinion unless he could argue the opposing side better than the people who held it, not just acknowledge the opposing view. Argue it convincingly. That's the standard. This technique is called steel manning, the opposite of straw mannings. Instead of attacking the weakest version of the opposing argument, you construct the strongest possible version and see if your position still holds. Imagine if ARK had done this in mid-2021. What's the strongest case against Tesla at $3,000? Competition is real and funded. Rising interest rates crush growth valuations. Automotive is a low-margin business at scale. Regulatory credits are disappearing. Full self-driving has been, next year, for 6 years. The robotaxi business model faces massive regulatory and liability hurdles. If you genuinely engage with these arguments, you don't necessarily abandon the position. But you might reduce position size. You might take some profit at $1,200. You might set a valuation threshold, where the thesis needs reevaluation. Small adjustments. But in a $60 billion portfolio, small adjustments mean billions in preserved capital. Another technique. Pre-commitment. Before making a major investment decision, write down the specific evidence that would prove you wrong. Not vague concerns. Specific metrics. For Tesla, it might be: if gross margins fall below 20%, I reevaluate. If full self-driving isn't commercialized by 2024, I reduce position size by half. If 3 major competitors achieve price parity with comparable range, I exit. Then you commit to following these rules, regardless of how you feel in the moment. Because in the moment, your brain will rationalize. It'll explain why this quarter's margin compression is temporary, why full self-driving delays are just regulatory caution, why competitor vehicles don't really compare. Pre-commitment removes the emotional negotiation. The final technique is the most uncomfortable. Seek out the smartest critics and listen. Not the trolls. Not the people who simply hate your position. The thoughtful critics who have done the work and reached a different conclusion. Read their research. Follow their logic. If you can't find a single smart person who disagrees with you, you're probably in an echo chamber. And remember the opening of this video. ARK lost 75% while the market was down 18%. That $60 billion lesson teaches us something profound. The cost of being wrong isn't just the loss, it's the opportunity cost of what you could have done differently if you'd been willing to question your own certainty. Confirmation bias doesn't make you look for the wrong information. It makes you blind to the right information that's been there all along. If this video changed how you think about your own blind spots, that's exactly why this channel exists. Subscribe for more psychology that explains how money actually works. Next, watch our video on the sunk cost fallacy and why cutting losses is the hardest skill in investing.